Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we consider a different topic and look to see if the lessons of the father of the craft, the late great Benjamin Graham, can shed light on the issues at hand. In this episode, we'll be taking a look at the South Sea Bubble, the event that many consider to be the world's first financial crash, and perhaps the world's first Ponzi scheme, way back in the year 1720. We shall take a deep dive into the causes of the bubble, look at the dangers of groupthink in the markets, and consider what lessons we can learn from the subsequent crash. For to quote the philosopher Santayana, those who do not remember the past are condemned to repeat it. So as ever, sit back and get ready for another lesson in value investment, Benjamin Graham style. The South Sea Company was a British private and public company formed in 1711, essentially as a means of consolidating, controlling and reducing the national debt, as well as to increase trade with the Americas. In order for it to generate an income, it was granted a monopoly in the abhorrent practice of trading African slaves to the Spanish and Portuguese empires in South America. This industry had proved hugely profitable in the past, and as such there was great public confidence that armed with a monopoly, this business would prove to be a goldmine, especially in anticipation of the end of the War of Spanish Succession, when it was anticipated that trade routes would flourish. Things did not turn out quite as planned on this front, however. The South Sea Company, confident of buoyant future trading conditions, had offered a huge 6% rate of interest. However, when the War of Succession finally did come to an end in 1713, the explosion in trade that had been anticipated did not arrive. Unfortunately for them, the Spanish only allowed very limited trade, and what trade that did take place was subjected to expensive tariffs. The profits being generated were nowhere near what had been expected, and not nearly enough to cover the interest payments that had been promised. Despite these travails, confidence in the company was to rise sharply again in 1718 as King George, Britain's reigning monarch, took charge of the business in 1718. Perhaps with parallels with the rise of a certain asset class today that has the political backing of a top political figure. This significantly boosted faith in the business, and the stock price continued on its inescapable rise. It was at this point that the business began to look like what we would today call a Ponzi scheme. Hugely attractive rates of interest being propped up not by fantastic trading profits, but rather by the company's ability to sell newly created stock at increasingly higher prices as a result of the attractive returns on offer. In short, it was the money generated from these new investments in the business that was used to pay the high rates of interest, and these fantastic rates of interest generating the demand for new investment, creating a self-perpetuating but ultimately unsustainable cycle. The company's stock price, which had been trading at £1.28 in January 1720, shot up to £550 just 5 months later, peaking at over £1,000 in August of the same year. Investors clearly began to believe that no price was too high to pay for this stock, which remember was still generating very little in terms of actual trading profits. It was September of 1720 when the inevitable disaster struck. The bubble had finally burst. By December, the stock price had fallen back to roughly the level it started the year at, shedding around 80% of its value from peak levels. Thousands of investors faced financial ruin. Many lost millions of pounds in today's terms. Perhaps the most famous loser in this debacle was the mathematician and scientist Sir Isaac Newton. Estimates vary, but some say he lost up to £40 million in today's terms. He would go on to lament that he could calculate the motions of the heavenly bodies, but not the madness of people. It proved to be a huge scandal, with the scheme being set up not by shady con men, remember, but by the king and his government themselves. Despite the huge fall from grace, the South Sea Company, somewhat surprisingly, continued to trade until 1853, albeit at price levels more in line with the profits generated from its trading operations. So what lessons can we take away from what was probably the world's first stock market bubble and Ponzi scheme? The first glaring thing to say is that bubbles are only ever created when the price of a stock becomes detached from the earnings a business makes from its actual operations. And secondly, how easy it is to get sucked into a mania. It's easy to dismiss those who get their fingers burnt by this and other Ponzi schemes of the past as being stupid or of low IQ, but when one of the world's most preeminent thinkers can get sucked in, then so can anyone else. As ever with these things, it all comes down to our natural human condition. We're all inherently greedy, and the thought of everyone else getting rich is a galling prospect. The South Sea bubble, as with the dot-com bubble boom of the late 1990s, if anyone actually sat down and thought about it logically, then they would run a mile. But group mania is contagious, and the main symptom is that logic flies out the window. Fortunately, the nature of the value investment discipline means that this is a trap that the seasoned practitioner is unlikely to fall into. However, it's always worth bearing in mind the powerful pull a mania can exert. Nobody is truly immune, and even a slight drop in our defences can lead you to the road of ruin. This leads us to wonder where the next South Sea bubble may crop up. The most likely candidate is surely already in our midst. The burgeoning cryptocurrency markets do worry me a lot. Full disclosure here, I'm not an expert in how they operate, and it doesn't interest me enough to become one. But to me, what we are seeing has so much in common with what we saw with the South Sea bubble. Both are commodities that have become highly detached from the reality of the situation. Perhaps even more so with crypto, given that at least the South Sea company did have an actual operating income, and therefore an underlying value. The stock price of the South Sea bubble company kept rising beyond levels that made rational sense. New investors being driven to invest by the idea that there will always be someone prepared to pay an even higher price, with late investors providing profit for early investors. Sharp rises after the support and backing from a reigning or soon-to-be reigning political establishment. Any of this sound familiar? Only time will tell, of course. But if history is any guide, and it nearly always is, a fool and their money will go their separate ways. Regardless of whether or not cryptocurrency markets will go down the same path as a South Sea company, one thing can be said for sure. Whilst investors continue to allow emotions to get the better of them, and while they remain susceptible to being swayed by the irrationality of the crowd, bubbles will continue to crop up from time to time. This is why following a strict framework is the only surefire way not to fall into these traps. This is why Graham's book, The Intelligent Investor, is as focused upon investor attitudes as it is on stock selection. The first lesson to learn to be successful financially on the stock market, or anywhere else for that matter, is simply the art of not losing money. It is a most unfair game, for the stock market can be a cruel mistress. For every ladder that will lead to your investment goals, there are half a dozen snakes intent on taking you to your financial ruin. More than half the battle, therefore, is avoiding these snakes. The teachings of Graham and others will help you in this endeavour. For as Graham said, the investor's chief problem, and even his worst enemy, is likely to be himself. That is all for this edition. I do hope you've enjoyed it and have something to take away from it. If you have, please do consider adding to playlist. That way you'll be alerted as new editions land, meaning you need never miss out on a lesson inspired by the Dean of Wall Street, Benjamin Graham. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.